Question 1. Which of the following best describes an insurable interest in insurance contracts? A. The interest that an insurance company holds in the insured's assets. B. The financial interest a policyholder must have in the property or person being insured. C. The amount of coverage a policyholder may need based on their income level. D. The risk associated with insuring an individual who does not hold a financial interest in the insured property. Answer B. The financial interest a policyholder must have in the property or person being insured. Explanation: insurable interest is a fundamental principle in insurance law that ensures a valid contract between the insurer and the insured. It requires the policyholder to have a financial or emotional stake in the subject of the insurance, ensuring that they would suffer a financial loss in the event of damage or loss to the insured property or person. This concept prevents speculative or gambling-like insurance contracts. Insurable interest must exist at the time of loss, though it is not always required at the time the policy is written, depending on the type of insurance. Question 2. Mr. Walker has been consistently misrepresenting the details of his car's safety features to an insurance company to reduce his premium costs. What could be the potential consequence of this behavior according to Indiana's insurance laws? A. Mr. Walker could face penalty for fraud under the Indiana Insurance Code. B. Mr. Walker's policy would automatically cancel if the insurer finds out about the misrepresentation. C. Mr. Walker could face fine for simply failing to disclose information. D. Mr. Walker's insurer could increase his premium, but no legal action would be taken. Answer A. Mr. Walker could face a penalty for fraud under the Indiana Insurance Code. Explanation: under the Indiana Insurance Code, misrepresentation is considered a form of insurance fraud. The law stipulates that knowingly providing false information in an insurance contract or claim constitutes fraudulent behavior. In Indiana, engaging in fraudulent practices could result in serious consequences, including civil fines, criminal charges, and the potential revocation of the individual's insurance producer license. The insurer may also deny claims or cancel the policy. Therefore, it is important to always provide accurate information during the application process. Question 3. Scenario: Mr. Smith is a new insurance producer in Indiana, and he is unsure about how to handle premiums collected from clients. He recently received premiums from clients for policies that he sold, but he did not immediately pass the payments on to the insurer. What should Mr. Smith do to ensure he complies with Indiana's regulations regarding premium handling? A. Mr. Smith should immediately deposit the premiums into his personal account for safekeeping until the next insurance company payment date. B. Mr. Smith should deposit the premiums into a trust account separate from his personal funds to ensure proper handling. C. Mr. Smith can delay passing the premiums to the insurer as long as he plans to remit them within 30 days. D. Mr. Smith should return the premiums to the clients if they are not immediately passed on to the insurer. Answer B. Mr. Smith should deposit the premiums into a trust account separate from his personal funds to ensure proper handling. Explanation: Indiana law mandates that insurance producers handle premiums in a fiduciary capacity, meaning they must safeguard client premiums before forwarding them to the insurer. To comply with the Indiana Department of Insurance regulations, premiums must be deposited into a trust account separate from personal funds, ensuring transparency and preventing misuse of the funds. Failing to do so can result in penalties, license suspension, or revocation. Producers are also required to account for these premiums properly and remit them to the insurer in a timely manner. Question 4. Which of the following is a primary responsibility of an insurance producer according to Indiana law? A. Ensuring that the insurer complies with its policyholders' claims without any interference. B. Verifying the solvency of the insurer before selling insurance policies. C. Maintaining fiduciary responsibility for client premiums and forwarding them to the insurer. D. Setting the premium rates for the insurance policies sold. Answer C. Maintaining fiduciary responsibility for client premiums and forwarding them to the insurer. Explanation: under Indiana law, insurance producers are required to act as fiduciaries when handling premiums. This means they must ensure that premiums are properly collected and transferred to the insurance company in a timely manner. Insurance producers cannot use premiums for personal gain or delay payment to the insurer. A failure to uphold fiduciary duties can result in severe penalties, including fines, suspension, or revocation of the producer's license. Insurance producers are not responsible for setting premium rates, which are determined by the insurer. Question 5. Which of the following best describes the concept of Reinsurance. A method by which an insurer shares risks with another insurer to reduce its own exposure. B. A policy that guarantees an insurer will be paid if its client defaults on a premium payment. C. A legal requirement for insurers to return a portion of premiums to policyholders after a claim is made. D. A system where insurance policies are bundled together to provide the insurer with higher returns. Answer A. A method by which an insurer shares risks with another insurer to reduce its own exposure. Explanation: reinsurances. A process where an insurance company purchases insurance from another insurer to mitigate the risk of large claims. This allows the primary insurer to transfer part of its risk exposure, particularly for catastrophic events, to a reinsurer. The use of reinsurance helps stabilize the financial strength of insurers, making them more capable of handling claims. It is not related to refunding premiums or bundling policies, but rather a way for insurers to manage risk more effectively. Question 6. Which of the following is an example of an unfair trade practice under the Indiana Insurance Code? A. Offering a policyholder a 10% discount for paying their premium in full. B. Providing accurate and truthful information about policy exclusions and coverage limits. C. Misrepresenting the terms, conditions, or benefits of an insurance policy to induce the purchase. D. Issuing a policy to a new client without requiring a medical examination. Answer: C. Misrepresenting the terms, conditions, or benefits of an insurance policy to induce the purchase. Explanation: Indiana's insurance code prohibits unfair trade practices, one of which includes misrepresentation. If an insurance producer makes false statements about an insurance policy's terms, benefits, or conditions to convince potential client to purchase policy, that constitutes an unfair trade practice. This could lead to legal and financial penalties, including license revocation or suspension. Offering discounts or disclosing terms clearly and accurately are acceptable practices as long as they comply with state regulations. Question 7. Under Indiana law, an insurance producer is required to A. Maintain records of policy transactions for a minimum of 2 years. B. Submit an annual financial audit to the Indiana Department of Insurance. C. Disclose commissions or fees collected from clients to the Indiana Department of Insurance. D. Complete continuing education requirements to maintain licensure. Answer: D. Complete continuing education requirements to maintain licensure. Explanation: Indiana insurance producers must complete continuing education. C. Requirements to maintain their license. The state mandates that producers attend C courses on various topics, including ethics, regulatory changes, and industry updates, to ensure they stay informed of current practices and legal requirements. Failure to complete the required C can result in license suspension or revocation. Insurance producers are not required to submit annual financial audits to the Department of Insurance unless specifically directed, and while records of policy transactions must be maintained, the period is typically longer than 2 years. Question 8. Mr. Miller purchased an auto insurance policy with a $500 deductible. He later files a claim for $4,000 worth of damages. How much will Mr. Miller's insurer pay for the damages? A. $4,500. The deductible is added to the claim amount. B. $3,500. The deductible is subtracted from the claim amount. C. $500 as the policy only covers the deductible amount. D. $4,000 as the deductible does not affect the payout. Answer: B. $3,500. The deductible is subtracted from the claim amount. Explanation: a deductible is the amount the policyholder must pay out of pocket before the insurer starts covering the damages. In this case, with a $500 deductible, Mr. Miller will pay the first $500 of the claim and the insurer will cover the remaining $3,500. The deductible is subtracted from the total claim amount, so the insurer's payout will be $3,500. Question 9. Which of the following insurance policies typically covers damage to a person's home and property from events like fire, theft, and vandalism? A. Health insurance policy. B. Homeowners insurance policy. C. Workers' compensation insurance policy. D. Life insurance policy. Answer: B. Homeowners insurance policy. Explanation: homeowners insurance is designed to protect individuals from financial losses due to damage or loss of property caused by covered events such as fire, theft, vandalism, or storm damage. This policy typically covers both the structure of the home and personal belongings inside. Health insurance, workers' compensation, and life insurance do not provide this type of coverage, as they are focused on different risks, such as medical expenses or disability. Question 10. In Indiana, which of the following is required for an insurance producer to maintain a valid insurance license? A. The producer must be employed by a specific insurance company. B. The producer must obtain written approval from the Indiana Department of Insurance for every policy sold. C. The producer must complete a minimum number of continuing education credits and renew the license periodically. D. The producer must undergo a criminal background check once every 5 years. Answer: C. The producer must complete a minimum number of continuing education credits and renew the license periodically. Explanation: to maintain an active insurance producer license in Indiana, producers are required to complete continuing education courses and renew their license periodically. This ensures that producers stay up to date with industry regulations, ethical standards, and product knowledge. While background checks may be part of the initial licensing process, they are not required every 5 years. There is also no requirement for producers to be employed by a specific insurance company, nor must they seek approval from the Department of Insurance for each policy sold. Question 11. Which of the following is a primary objective of the Indiana Department of Insurance, IDOI? A. To provide financial compensation to policyholders in the event of an insurer's insolvency. B. To regulate insurance rates and ensure they are fair and not discriminatory. C. To offer insurance products to consumers at discounted rate. D. To provide legal representation for policyholders in insurance disputes. Answer: B. To regulate insurance rates and ensure they are fair and not discriminatory. Explanation: the Indiana Department of Insurance, IDOI, is responsible for overseeing and regulating the insurance industry in Indiana. One of its key objectives is to ensure that insurance rates are fair, reasonable, and not discriminatory. The IDOI evaluates insurance rate filings and ensures that rates are adequate for covering potential risks while being fair to consumers. It does not directly provide compensation to policyholders, offer insurance products, or provide legal representation in disputes. Question 12. Which of the following is a type of insurance that would typically cover damage caused by natural disasters such as hurricanes, earthquakes, or floods? A. Homeowners insurance. B. Flood insurance. C. Auto insurance. D. Workers' compensation insurance. Answer: B. Flood insurance. Explanation: flood insurance specifically covers damage caused by flooding, which is not typically included in standard homeowners insurance policies. Homeowners insurance may cover some natural disasters such as wind damage, but flooding usually requires a separate flood insurance policy. Auto insurance may cover vehicles damaged in floods but does not protect homes or other property. Workers' compensation is for workplace injuries, not natural disaster coverage. Question 13. Under Indiana law, which of the following is an example of an unfair trade practice by an insurance producer? A. Offering a policyholder a 5% discount for completing a health assessment. B. Misrepresenting the terms of an insurance policy to persuade a customer to buy it. C. Providing clients with detailed policy information and exclusions in writing. D. Offering multiple insurance quotes from different insurers to clients. Answer: B. Misrepresenting the terms of an insurance policy to persuade a customer to buy it. Explanation: under Indiana's insurance regulations, misrepresentation of policy terms is considered an unfair trade practice. This can involve exaggerating or falsifying the benefits, terms, or coverage of a policy to induce a potential customer to purchase it. Ethical practices require that producers provide accurate, clear, and truthful information regarding policies. Offering discounts or quotes is permissible as long as the information is truthful. Question 14. Mr. Williams is a policyholder who has filed a claim for a car accident. The insurance company investigates the claim and determines the damage exceeds the policy's deductible. What is the next step in the claims process? A. The insurance company denies the claim due to insufficient evidence. B. The insurer adjusts the claim based on the deductible and issues a payment for the remaining balance. C. The insurance company cancels the policy due to the claim. D. The insurer immediately provides the full amount of the claim without adjusting for the deductible. Answer: B. The insurer adjusts the claim based on the deductible and issues a payment for the remaining balance. Explanation: once an insurance claim is investigated and determined to be valid, the insurance company will adjust the claim according to the policy's terms. If there is a deductible, it is subtracted from the total claim amount. In this case, the insurer will pay the remaining amount of the claim after accounting for the deductible. The full claim amount is not paid unless there is no deductible or the damage is less than the deductible. Question 15. Which of the following is an example of A rider in a life insurance policy. A. A policy feature that covers medical expenses. B. A provision that automatically increases the death benefit based on inflation. C. A clause that denies coverage for suicide during the first 2 years. D. A cancellation clause allowing the insurer to terminate the policy after a certain period. Answer B. A provision that automatically increases the death benefit based on inflation. Explanation. A rider is an additional provision that can be added to a life insurance policy to modify its coverage. In this case, a rider that automatically increases the death benefit in line with inflation is a common option. Riders can be used to customize coverage to fit the policyholder's needs, such as adding disability or accidental death benefits. Riders are not cancellation clauses or exclusions, which are separate policy provisions. Question 16. Which of the following factors typically influences the premium rates for health insurance policies in Indiana? A. Policyholder's occupation. B. Policyholder's medical history and pre-existing conditions. C. Policyholder's age and gender. D. All of the above. Answer D. All of the above. Explanation. Health insurance premiums are influenced by multiple factors, including the policyholder's occupation, which can affect risk, medical history, including pre-existing conditions, and demographic factors such as age and gender. Insurers use these factors, along with others, to assess the level of risk and determine appropriate premium rates. For example, older individuals and those with certain medical conditions may be charged higher premiums due to higher anticipated healthcare costs. Question 17. Which of the following would not be covered under a standard homeowner's insurance policy? A. Fire damage to the home. B. Theft of personal belongings inside the home. C. Injuries caused to guests on the property. D. Flood damage caused by a nearby river. Answer D. Flood damage caused by a nearby river. Explanation. Standard homeowners insurance policies generally do not cover flood damage, especially if the flood is caused by natural events like a nearby river overflowing. Homeowners insurance typically covers fire, theft, and liability for injuries on the property, but flood damage requires a separate flood insurance policy. Homeowners should purchase additional flood coverage through the National Flood Insurance Program, NFIP, or another flood insurance provider if they are at risk. Question 18. Mr. Walker has a workers' compensation policy that covers medical expenses for workplace injuries. However, he was injured while commuting to work. Will his injury be covered under the workers' compensation policy? Yes, because all injuries are covered under workers' compensation policies. B. Yes, because injuries occurring during the commute are automatically covered. C. No, because workers' compensation generally does not cover injuries sustained while commuting. D. No, because workers' compensation only covers injuries that occur off the jobs. Answer C. No, because workers' compensation generally does not cover injuries sustained while commuting. Explanation. Workers' compensation policies typically cover injuries that occur during the course of employment. Injuries sustained while commuting to or from work are usually excluded from coverage unless the injury occurs during a work-related travel event or while performing a work-related task. Commuting injuries fall outside of the standard coverage and are generally not covered. Question 19. Which of the following is not a characteristic of term life insurance? A. The policyholder is covered for a specified period of time. B. The policy has a cash value component that builds over time. C. The policy premiums remain fixed for the term of the policy. D. The policy pays a death benefit if the policyholder dies during the term. Answer B. The policy has a cash value component that builds over time. Explanation. Term life insurance provides coverage for a specific period, e.g. 10, 20, or 30 years, and does not have a cash value component. If the policyholder dies during the term, the beneficiary receives a death benefit. However, term life policies do not accumulate cash value like whole or universal life policies, which have an investment component that grows over time. The premiums for term life insurance can either be level, fixed, or may increase after the term period ends. Question 20. Which of the following insurance policies would typically cover legal costs related to a lawsuit arising from a car accident? A. Life insurance. B. General liability insurance. C. Auto liability insurance. D. Health insurance. Answer C. Auto liability insurance. Explanation. Auto liability insurance is designed to cover the costs associated with injuries or damages caused by the policyholder in a car accident, including legal defense costs if the policyholder is sued. Life insurance provides a death benefit but does not cover legal expenses. General liability insurance typically covers businesses, not individuals, while health insurance covers medical costs but not legal expenses related to accidents. Question 21. Which of the following is a common exclusion found in most homeowners insurance policies? A. Damage caused by fire. B. Theft of personal property. C. Flood damage. D. Personal liability for accidents on the property. Answer. C. Flood damage. Explanation. Most standard homeowners insurance policies do not cover flood damage. Homeowners need to purchase separate flood insurance through the National Flood Insurance Program (NFIP) or other private insurers if they want coverage for floods. Fire, theft, and personal liability are typically covered under standard homeowners policies. Question 22. Which of the following is an example of a moral hazard in insurance? A. A policyholder exaggerating the value of their property when filing a claim. B. A driver's failure to wear seatbelt while driving. C. House being damaged by natural disaster despite having insurance. D. Policyholder accidentally breaking their phone. Answer. A policyholder exaggerating the value of their property when filing a claim. Explanation. A moral hazard refers to the tendency of individuals to take more risks or act recklessly because they know they are insured. Exaggerating the value of property when filing a claim is an example of moral hazard because the policyholder might be more inclined to commit fraud knowing they will be compensated by their insurance. The other examples are either due to accidental or non-insured factors. Question 23. In a homeowner's insurance policy, which of the following types of coverage is typically included in personal liability protection? A. Coverage for damage to personal property due to a fire. B. Legal fees and medical expenses if someone is injured on your property. C. Coverage for your car when you're involved in an accident. D. Protection against flood damage. Answer. B. Legal fees and medical expenses if someone is injured on your property. Explanation. Personal liability coverage in a homeowner's insurance policy helps cover legal fees, medical expenses, and other costs if someone is injured on your property or if you're responsible for damaging someone else's property. It does not cover vehicle-related accidents, flood damage, or damage to your personal belongings. Question 24. Which of the following best describes an umbrella insurance policy? A. A policy that covers damage to your home and personal property. B. A policy that provides coverage for liability in excess of other insurance policies. C. A policy that covers medical expenses incurred during a serious illness. D. A policy that provides coverage only for business-related risks. Answer. B. A policy that provides coverage for liability in excess of other insurance policies. Explanation. Umbrella insurance is a type of liability insurance that provides additional coverage beyond the limits of your existing policies, such as auto or homeowners insurance. It offers extra protection for large claims, including legal fees and judgments. It is not limited to business risks or medical coverage. Question 25. Which of the following is an example of a deductible in an insurance policy? A. The amount an insurer pays to the policyholder after a claim. B. The amount the policyholder must pay out of pocket before insurance kicks in. C. The percentage of the claim amount that the insurer pays. D. The maximum amount a policyholder can be reimbursed for a claim. Answer. B. The amount the policyholder must pay out of pocket before insurance kicks in. Explanation. A deductible is the amount a policyholder must pay out of pocket before the insurance company starts covering the remaining costs of a claim. For example, if your car insurance has a $500 deductible, you'll need to pay the first $500 of the damage costs, and then your insurer will cover the rest. Question 26. Which of the following would typically not be covered under a standard health insurance policy? A. Prescription medications. B. Preventative care services. C. Cosmetic surgery for aesthetic reasons. D. Emergency medical treatments. Answer. C. Cosmetic surgery for aesthetic reasons. Explanation. Cosmetic surgery that is performed solely for aesthetic purposes is generally not covered under standard health insurance policies. Health insurance typically covers necessary medical treatments, including emergency medical services, preventative care, and prescription medications, but elective cosmetic procedures are usually excluded unless deemed medically necessary. Question 27. Which of the following is required to maintain a valid life insurance policy in Indiana? A. The policyholder must update their beneficiary designation every year. B. The policyholder must pay premiums regularly and on time. C. The policyholder must file a claim within a year of death. D. The policyholder must notify the insurer of any changes in health status. Answer: B. The policyholder must pay premiums regularly and on time. Explanation: to keep a life insurance policy in force, the policyholder must pay premiums regularly and on time. Failure to do so may result in the policy being lapsed. While it's a good idea to keep beneficiaries updated and inform the insurer of any major health changes, regular premium payments are the most critical factor in maintaining coverage. Question 28. What is the primary purpose of a rider in an insurance policy? A. To increase the amount of coverage for a specific risk. B. To decrease the premium cost of the policy. C. To provide an automatic renewal option at the policy's end. D. To waive the deductible for certain claims. Answer A. To increase the amount of coverage for a specific risk. Explanation: a rider is an additional provision or amendment added to an insurance policy that alters or extends the coverage. Riders can increase the amount of coverage for a specific risk or provide additional benefits. For example, in life insurance, a rider might add accidental death coverage or disability benefits. Question 29. Which of the following statements about whole life insurance is true? A. The policyholder is only covered for a set period of time. B. The policy builds cash value over time. C. The premiums decrease as the policyholder ages. D. The policyholder must pass a medical exam every year. Answer: B. The policy builds cash value over time. Explanation: whole life insurance is a type of permanent life insurance that not only provides a death benefit but also builds cash value over time. Its cash value can be borrowed against or used to pay premiums. Unlike term life insurance, whole life provides coverage for the policyholder's entire lifetime. Premiums remain consistent, not decreasing as the policyholder ages. Question 30. Under the Indiana uninsured motorist coverage law, which of the following would be covered by an uninsured motorist policy? A. Damage to your car caused by a collision with a drunk driver. B. Injuries you sustain in a car accident caused by a hit-and-run driver. C. The cost of repairs for your car after a collision with another insured vehicle. D. Property damage to someone else's car in an accident that is your fault. Answer: B. Injuries you sustain in a car accident caused by a hit-and-run driver. Explanation: uninsured motorist coverage protects you if you are involved in an accident with a driver who does not have insurance, or in cases of hit-and-run accidents where the at-fault driver cannot be identified. It generally covers medical expenses and sometimes property damage resulting from these types of accidents. It does not cover damage to your vehicle when the other driver is insured, or cover damage caused by your own fault.